Now, this is the profit or loss on disposal for the parent. Right? The parent in its own separate financial statements will calculate this profit. And now we calculate the profit on consolidation. From the viewpoint of the consolidated financial statements, we compare whether the asset will increase or reduce after the disposal. If the asset increase, gain. If the asset reduce, loss. What will be the increase in asset? Because of the disposal, of course, you got a sales profit because you sell the shares, therefore you got some cash or any kind of consideration. This is the sales profit. But not only sales profit, if you can still remember, we say that the remaining investments, those 5% and 20%, should be carried at fair value. Because after you dispose your subsidiary, you still have some remaining investments. Right? These remaining investments should be carried at fair value, and therefore we will have the fair value of the remaining investment. This should be carried at fair value. This is the increase in asset. Right? So by selling your subsidiary, you got sales profit, and you have got the remaining investment at fair value. But because you dispose a subsidiary, everything related to this subsidiary disappears. So you lose everything of the subsidiary. Right? You lose all the goodwill, fair value adjustments, and the book value of the net assets of the subsidiary. Right? But the effect will be reduced because of the NCI. Right? So that's why this is the net assets of the subsidiary that you no longer can consolidate. Right? So if what you get is more than what you lose, this is a gain. If what you get is smaller than the subsidiary that you have disposed, then you got a loss. Okay? So this is only relevant for disposal resulting to a loss of control. If you did not lose control, as I've said before, this is not a disposal of subsidiary. If this is not a disposal of subsidiary, no profit, no loss, no need to calculate. Right? And then the fair value of the remaining investment, that fair value of the remaining 5% or 20% will become the new cost, right, for the investment. And on the day of disposal, if you have got any other comprehensive income related to the subsidiary, right, if this is a disposal subsidiary, you have already disposed it. So any relevant reserve related to this subsidiary must be clear. So if you have got a revaluation reserve, translation reserve, etc., remember to clear it. You debit it away, and then you transfer it to retained earning. Okay? And if this subsidiary is significant, if this is a significant subsidiary, that it amounts to a so-called discontinued operation. So if this is a separate major line of business or geographical area, etc., then it may amount to a so-called discontinued operation. Right? If this is a discontinued operation, anything related to a discontinued operation should be separately disclosed. In your consolidated financial statements, in your consolidated income statements, those sales, cost of sales, etc., should include only continuing operations. You have studied financial statement analysis, ratios. You understand that when we calculate ratios, we try to exclude those non-recurring items. Discontinued operation is non-recurring item. It will not happen again. It will not happen in the future, right? So that's why we exclude it, and therefore we exclude it from those continuing operations. So therefore, after all the continuing items at the bottom, you have the profit from discontinued operation, and then you have the profit. Okay, so if this disposed subsidiary is significant enough that it amounts to a major line of business or major geographical area, then you regard it as a discontinued operation.